Hey, Dan Passarelli here, and happy Friday. Holy cow, it is a well-deserved weekend on a pretty darn interesting week. Up on the week, but today was what we call unched. That is unchanged. Now, it was kind of an interesting day playing out. First of all, if we just look here at the one-day candles, we see that it did try and make a little bit of a push higher. We're up about $3, something like that earlier, on very, very low volume. And most of that volume happened at the very end. Well, not most of the volume, but a lot of that volume happened in the very end of the day. Now, you might ask yourself, why is the volume so low the past couple of days? Well, it's because of uncertainty. It's because of the shutdown, because we didn't get the financial data on employment that is kind of the most important data that people need to know right now. All we got was the ADP data this week, and ADP is a private company, and they only represent about 10% of the payrolls nationwide, so who cares? We didn't get the good key data. Now, from a technical standpoint, we've got another divergence here. We've got a high on the RSI, high on the chart, and then we've got a higher high on the chart, but a lower high on the RSI, which typically signals a pullback. A lot of times those pullbacks just last a couple of days, and hey, maybe that could be it. But I've been expressing some caution and suggesting that our family of traders here, the Market Taker family of traders, proceeds with caution, maybe considers protecting the downside a little bit. And here's one of the reasons why. So this is a chart of the trailing 12 months PE ratio for the past 20 years. PE ratio, of course, is the stock price divided by the trailing 12 months earnings. It gives you an idea as to, relatively speaking, how expensive our stock price is. And the answer is they're really freaking expensive. It's only been higher twice in the past 20 years, and those were gigantic catastrophes. That was the COVID thing, and that was the 2008-2009 financial crisis. Now, if we go back all time, even the massive rally that happened after World War II, stocks are, in relative terms, still priced way above them. Way, 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 way above them. And if we go back to the dot-com bubble, well, that was higher too. So the dot-com bubble, tech wreck, financial crisis, and COVID, the only three times, literally in history, that stocks have been priced at these nosebleed levels. So, like I said, that's not going to derail you from trading or even investing, but it should frame your thoughts in it, and it should frame how you think about protecting yourself. I hope that helps. This is Dan Passarelli. Trade smart.